Okay, let's set the scene. Imagine it's late 2025, and you are Apple CFO Luca Maestri, looking out over that perfect circle of Apple Park. On your desk, you've got two plans. And these two plans outline two completely different futures for your company. One continues the hyper-disciplined strategy that made Apple a fortress of profit. The other is a radical multi-billion-dollar bet on survival.
So, to really get what's at stake here, you have to wrap your head around the sheer, mind-boggling scale of Apple's success. By 2025, its market value is an almost unbelievable $3.45 trillion. I mean, it is the absolute apex predator of the corporate world.
The company just seems completely untouchable, doesn't it? It's a financial fortress. But here's the kicker. What if the biggest threat isn't some rival company, but a fundamental technological shift? A shift your whole fortress just wasn't designed to handle.
All right, so let's dig into that. Before we even talk about the threat, we have to really appreciate the fortress itself. This is Apple at the absolute peak of its power. And look at these numbers. They're just staggering. But it's not just about the individual stats, it's how they all work together, right? It's this powerful, virtuous cycle. A massive cash pile gives you incredible flexibility. Billions of devices create a captive audience for over 1 billion high-margin subscriptions. And the whole thing sits on the foundation of the iPhone, which is basically a $200 billion a year gateway drug to the entire ecosystem.
And the guy behind all this, the architect of this whole financial empire, he has a guiding philosophy. We're calling it the Maestri Doctrine. And it's all about extreme efficiency, a laser focus on profits, and maybe most importantly, a deep, deep commitment to returning cash to shareholders. And the result of that doctrine is, no, it's pretty incredible. The North Star for every single decision at Apple is something called Return on Invested Capital, or ROIC. Just look at this chart. It tells you everything you need to know. Apple generates an astonishing 64.4% return, while the rest of the entire tech sector averages just 3.8%. They're playing a totally different sport.
So, what do you do with all that hyper-efficient profit you're printing? Well, you give it back. And this number, honestly, it's just wild. In less than 12 years, Apple spent over $674 billion just buying back its own stock. That is the main output of this incredible machine, making the stock more and more valuable for investors.
But here's the twist. While Apple was busy polishing every last stone of its financial fortress, the entire battlefield outside its walls, it was changing, dramatically. The AI revolution had officially arrived. And you better believe Apple's biggest rivals were not sitting still. They were on the attack. Google wasn't just, adding a few AI features. It was weaving its Gemini models into the very DNA of everything: Android, search, workspace. Microsoft was pushing full steam ahead on the agent-enabled workplace, positioning its Copilot as your new indispensable assistant. This wasn't a small skirmish. This was a full-blown AI offensive. And you know what? The market was starting to notice. People were getting nervous. This quote from an analyst report back in 2025, it just perfectly captures that growing fear. For a company that built its entire brand on being ahead of the curve, the idea of being 1 to 2 years behind was a massive, flashing red warning lights. And this is the really crucial point, so listen up. This isn't just about Siri getting a little bit smarter. This is a potential platform shift. The real risk here is that if all the magic, all the intelligence, moves from that beautiful device in your hand to some invisible AI agent in the cloud, then what is the iPhone? It just becomes a dumb terminal, a portal. It gets commoditized. And make no mistake, this is where all the money, all the growth was headed. I mean, look at this. The generative AI market was set to just explode, from about $71 billion in 2025 to nearly $900 billion by 2032. You just can't ignore that. This is a once-in-a-generation gold rush, and Apple was kind of sitting on the sidelines. So that leads to the billion-dollar question, or in this case, the many-billion-dollar question. What would it actually cost for Apple to get serious about this AI arms race? And this is where our CFO's dilemma gets really, really painful. Okay, this table right here lays out the brutal trade-off. To become a real AI-first company, analysts figured Apple would need to nearly double its annual investment in R&D and capital projects. That's an extra $35 billion a year. Now, where does that money come from? Well, just look down at the bottom for comparison. That $35 billion, that's a huge bite out of the $85 billion it was spending every year just buying back its own stock. And this brings us right back to those two folders sitting on Luca Maestri's desk. Proposal A, the Shareholder Supremacy Plan. Basically, you double down on the playbook that's been working like a charm. Then there's Proposal B, the AI First Thesis. And this is the total opposite, a radical, defensive move to make sure you're still relevant in 10 years. All right, let's break these down. First up, Proposal A. You could call this the path of least resistance. It's the choice that basically says, hey, what we're doing is working, so let's just do more of it. The game plan here is pretty simple, pretty straightforward. You authorize a new record-shattering $150 billion buyback. You increase the dividend for the 14th year in a row, and you keep spending on R&D and new buildings on its current disciplined path. What does this all do? It sends a powerful message of unwavering confidence in the current model. It's business as usual, but on steroids. Okay, now for the other door, Proposal B. This one isn't about confidence at all. It's about insurance. It's a huge, probably painful, bet on long-term survival. And the argument is that it's absolutely necessary. And the actions here, they are the polar opposite of the first plan. First, you slam the brakes on share buybacks, or at least slow them way, way down. You need that cash. Then, you plow it into a massive build-out of AI data centers and set up a $30 billion war chest to go out and buy the AI companies and talent that Apple desperately needs to catch up.
So that's it. It all boils down to this single moment. Two proposals, two completely different visions for the future of Apple. A truly legacy-defining choice has to be made.
And really, this decision is about choosing what kind of company Apple is going to be from this point forward. Is it Vision 1, the financial powerhouse? A mature, ultra-disciplined company whose main job is to maximize returns for its investors? Or is it Vision 2, the innovator's fight? A company that's willing to sacrifice that short-term financial perfection to fight for its spot as the world's leading innovator?
And that leaves us with the final hanging question. It's a classic choice, right? Reward the people who helped you get here today, or pay a massive price to secure your spot tomorrow. So now I'm turning it over to you. If you were in that chair, staring at those two plans, what would you do? And more importantly, why?